All right, so
The
equities, we
Christmas trees
start.
are back.
Yes, yeah, it's so great for Christmas. I had to use the picture. You know, you pay for it on iStock, so you got to use it. Get your money's worth. 12 days of Christmas, baby. So the our equity theme when we started January, we liked certain parts of equities, but we thought it'd be a stagflation year. We were really light on the Mag 7 and the technology names because of valuations. Then April and May came and the tariff tantrum happened, gave us an opportunity to readjust the portfolio. And we went into this barbell theme where we had names that could benefit from stagflation. We had names that that were technology names. And then we also had names that were focused around deregulation that the Trump administration is focused on. And we had a great summer and fall. And since then, things have just kind of gotten grindy sideways. And right here is a chart of the S&P 500. And the only thing to really care about if you're a long-term investor, if you're a day trader, there's all kinds of things we can get into. But if you're a long-term investor, all you really care about is this long-term bull and bear line, which we came down and touched. In fact, we kind of crossed over it in April and got everybody scared. And we touched it, right here in November. We've had a little bit of a correction in the market, and corrections can happen in two ways. You can get a price correction. This is a great example back here in April of a price correction where price moves down really fast, 10, 20%, and then rebounds from there. And then you can get corrections that are in time. And corrections that are in time just grind sideways. They just kind of just drive you nuts, like a top spinning on a stick. And that's what this really looks like here. Is you just have a situation where markets had some great growth since April, and now they're just digesting this in a way that spreads over time, and not price as of yet. That can change. If you get a scare in the market, something goes wrong, somebody sneezes wrong, maybe, and you would, and you could get a quick downdraft, then we might have a different story. But that's not in the charts right now. But what's interesting is you can kind of see through that sideways grind, we're coming to that bull bear line, not in a dramatic way. So January, February, March of next year will be very, very telling, because it's very normal in a midterm year to have a little bit of strength in the first quarter, be really, really weak in the second and third quarter, and then a rally back in the fourth. So you could have a year next year that maybe the S&P 500 is positive, but maybe it spends 6 months of the year negative doing that. So there's a lot of ways to get to Sunday, but so we'll see how this goes. And this, by the charts, from what I'm seeing here, this is a market that's saying, it's tired. Is it rolling over? Well, we don't have confirmation of it rolling over and becoming bearish until you start to break through supports, and that's not happening right now. So don't worry about it. When it happens, we'll address it. But right, and as we get closer to it happening, we'll see signs. So that's my read on the overall stock market. It's important to put a caveat of caution there, guys, because as Jason Haver at Pretzel Charts, who's great at charting things and has a great intuition and a great process, has pointed out that we're in an unprecedented market, and it doesn't mean that doesn't matter that it can't keep. It doesn't mean that the market can't keep going higher. It just, we're in uncharted waters, right? So we got to be on our toes that there could be a change of trend at some point. So don't get complacent is the point there. So, we've handled the year with this barbell approach where we have some of the old school names, energy names, Exxon, Chevron, blah, 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 some utility names, all high dividend payers to create cash flow in the portfolio. They're stodgy companies We've had a small amount of traded REITs. Could have been bigger, but as we explained earlier, some of the concerns. And then we had the legacy tech, the Amazons, the Googles, the Microsofts, and things of that nature. And then on the deregulation and on the emerging tech side, as we got into summer, what we added is we added crypto names, and we're not talking Bitcoin. We're talking the picks and shovels to crypto. The Robin Hoods, the Coinbases, the Circles, the Bullish, companies like that. They're in the inner workings of all the trading that goes on in this, because crypto is here to stay. The industry is getting structured. All these things get traded. So my way of doing things is get into the picks and shovels when you don't know exactly where that industry is going yet, but it's early. A lot of advances in fintech. Aerospace has totally changed. Not just Boeing. You've got all kinds of things going on with electric vehicles, drones, autonomous vehicles, AI in aerospace, all kinds of stuff. We can let Patrick talk about that. Quantum computing, very speculative, but a couple names in there that seem to be the leaders. And then you'll see energy listed twice because there's a new energy. Justin touched upon it when he was talking about utilities and AI. But along that, you've got other sources of energy, uranium, nuclear, things of that nature that have started to get some attention. So those are all things that we've looked at and either had in the portfolio and traded around. And then, the look at those things as the plates on the barbell on the sides, and then the metals, the middle of it, the bar being metals and select energy commodities that we've had in the portfolio. And metals have done damn good this year, thank God. So that's worked pretty well this year. Guys, anything you've learned? There's a few things I definitely learned this year about portfolio management. As we wrap up the year and I kind of throw out what the sectors of the strongest relative strength are now as we end the year and start 2026. Is there anything you guys would have done differently this year? As you look back on hindsight, is there anything you would have bought more of that you regret buying? That and vice
As you
versa.
look back, there's always things you wish you
And
bought
with that,
more of.
anything you want to do in the future?
I think you missed a perfect opportunity to put packages on the dumbbell thing rather than leaving the dumbbell up there.
Yeah, I should have put the trees there too.
Yeah. Justin, you?
Yeah, I mean, I wish we would have. I mean, I wish I would have bought more gold and silver, especially silver, the last few days or
For
week.
sure. I wish I only had gold and silver in the portfolio.
Yeah, they really have
Sure.
knocked it out of the park this year for sure.
Yeah.
What also made kind of a late comeback was palladium too.
Mm-hmm. The palladium was all over the place. We had some great trades with
Yeah,
palladium.
yeah,
But
and then for whatever reason, it was I feel like the first half of this year it was kind of just all over the place, down being specific, but and then
yeah.
I think now it's up, from I don't know, we were looking at it when it was at 60, well, I guess it'd be like 70 or $80, and I think now it's at like 126 or something. So it's just interesting. I didn't see that one coming.
My regret is Palantir. I wish I had listened to you guys.
Oh,
And I know you suffered an entire year with that stock before it finally popped. But man, when it popped, it popped.
I bought it in the 20s and had to suffer all the way down to 14, and I thought I almost gave up, and then the thing just becomes the next conversation point at every party.
Yeah.
When we bought it, nobody even knew what it was. They were like, "Huh?" And we're like, yeah, they do cyber. They're the ones that caught Osama bin Laden, and they're going to catch the devil and the Antichrist. They're going to catch them all because they are them. And they're like, huh? And yeah, and now it's a stock everybody talks about.
Yeah.
Yeah. I would say I definitely wish I would have leaned into more of that. I would have, if on hindsight, I would have trimmed my energy exposure and put it other places sooner. It's working now. Like energy's ending the year with relative strength, and it started the year with some. It was a real tease. Like energy was the worst prom date you could ever have this year. Because it teased you in the beginning and teased you it's teasing at the end, but there's just no action has happened. So I would say that would be on hindsight. I would have, liked that money somewhere else. Going forward, I really like the look of healthcare and finance. Healthcare, I hate. I just hate healthcare. I mean, Johnson and Johnson's tried to kill everybody 1,000 different ways over the years, right? I mean, talcum powder. How can you try and kill people with talcum powder? Um, painkillers. You're trying to kill pain. Don't kill me. So, but the charts look great in healthcare right now. So they've had an interesting turn the last couple months. If interest rates if the fear of interest rates rising is there, like on the 10-year, even though the Fed could lower, then financials will do well in that realm. So looking out to 2026, those are two sectors that weren't on my radar in the beginning of 2025. And then Justin, you brought me, my attention to materials last week, and that those look interesting. Like I wouldn't be too surprised to see money, like profit taking from gold and silver, trickle over to materials sector. I could kind of see that happening. Is there anything you guys like as you guys look forward? Anything you like better than anything else?
I want to find out how much of that $7 trillion that's been sitting on the sidelines has been put to work. I want them to come out with a new estimate, because if none of that money really has gone into work yet, I don't think it really matters what sector. If people start putting that money to work, everything is just going to rally, because that's
Everything
a
goes.
lot of money. Yeah.
Well, yeah. Well, that brings the conversation to liquidity. So we'll come back to that. What about you, Justin?
Yeah, just the materials, kind of like what you had mentioned. I think with going, all the things that they need to, again, to fund the energy things, the utilities, I think there's going to be materials could see a nice good head or tailwind, rather, not a headwind.
Yeah. Yeah, no, I like that. Well, let's wrap this up and get into gold, silver, and then the dollar, and end it for the night. And and I'm then as I give the bottom line, I'm going to have a little rant around liquidity, because that's really, if you want interest rates to stay stable, if you want equity markets to go higher, if you want gold to stay stable or at least going higher, if you want the dollar to stay stably weak, like as Americans, we want a strong dollar. We want pride in the dollar, but economically, we kind of want a stably weak dollar. Like we want it kind of at the levels it is now, but not threatening to go too high. If those things are happening, then the trend is your friend, because in that kind of environment, liquidity stays, and liquidity is everything. And you can look at liquidity like spigots of water coming into the market, feeding it. And you have a Fed announcement from last week saying that starting December 12th, a couple of days ago, the Fed is doing $40 billion of purchases in T-bills, in short-term T-bills. Essentially quantitative easing. So they've gone from tightening, taking money off the balance sheet, to now adding it very quickly, and they're going to do that till April. So that's an addition of liquidity. You then in January have a ton of tax returns. It looks like this year will be one of those big years for tax returns. So that's liquidity that comes in on the consumer side. And then you have the change going on in the Fed, which I know takes a Fed chairman time to get, consensus, blah, 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 blah. So we don't expect things overnight. But nonetheless, you have a situation where this president has a friendly Fed, a friendly treasury, a friendly court system, and that's a lot of liquidity bring into this market. So back to Patrick's point, regardless of the sector, you have a situation where it could be a rising tide if this money comes in, which it usually goes that way.
You
So the
also
trend is
have
your friend.
You also have a yen carry trade that is very favorable too. Nobody's really been talking to that because that didn't blow up like everybody was thinking. But now the yen is way down again. So
it reset. Yeah.
Yep.
Like the yen carry trade was something we talked about earlier this year as a concern, and it's actually kind of reset itself. Like, so there you go. Good point. So we've had two types of corrections this year. We've had a drastic one in April, and now it looks like we're getting a sideways one. Let's hope it stays that way. And but nonetheless, we are in unprecedented territory. So I'm not trying to be Pollyannish here. It's just I've always told clients and everybody that if the sun's out, we're going to make hay. And right now the sun's still out. So let's keep making hay. And if clouds come, we'll change. So we're not going to stay complacent. One thing we didn't talk about is in the relative strength world. One way that money managers are really frisky and that the bull market is kind of in its firmness is that you watch small caps and high yields, because if small caps and high yields are leading the market higher, and they have been for a few weeks, that's typically a good sign. So that's what I'm going to watch. That's going to be the early tell for me in the equity markets, is when the small caps and the high yield debt markets start breaking levels of support, then I'll come out and start to talk to you guys about, hey, should we be concerned? Will that be an early sign that gives us an idea of repositioning makes sense? But for right now, markets broadening, financials, healthcare, they weren't on the radar last year. So the barbell approach continues to work. We're just going to have to, in 2026, adjust those sectors on the barbell as this market broadens out. And we've already started to do that.